ONGC, a company faced with the unique challenge of balancing profitability with national oil bill. ONGC, a Maharatna PSU, has market leadership in exploration and production of oil and gas. It deals with over 70% of India's crude oil, enjoys a massive market capitalization, integrated operations from upstream exploration to downstream refining and petrochemicals, expanding into LNG and ethane value chains, dominant Government of India ownership. Institutions hold over 37% in aggregate. India operations predominantly determine the revenue and profits. Standalone performance of ONGC is further strengthened by the two subsidiaries, Hindustan Petroleum Corporation and Mangalore Refineries and Petrochemicals. Global presence in over 15 countries covering Far East, Russia, Middle East, Africa and Latin America. Collaboration with global majors for superior technology and expertise. Also partners with prominent domestic players like Oil India, Reliance and Bharat Petroleum, particularly for exploration and development projects. Aggressively diversifying into renewable energy, significantly increasing its investment in green energy projects, acquires PTC Energy, a subsidiary of PTC India, with its operational wind power capacity, set up a joint venture with NTPC Green Energy to develop renewable energy projects. The ONGC standalone entity contributes about two-thirds of the consolidated profits. Standalone profits for Q1 and Q2 has been a disappointment, a significant double-digit fall, largely due to decline in crude oil prices. Profit from subsidiaries, both local and overseas, has widely fluctuated over quarters but remained quite positive and sizable over last 3 quarters. In particular, at the consolidated level, the TTM profit percentage has registered a substantial improvement over the 7.9% low of FY25, but a long way to go to beat 11.4% of FY24. A very positive net operating cash flow over years, driven by strong realizations from favorable prices of crude and natural gas, operational efficiencies contributing in a big way to better margins and comfortable liquidity, effective management of working capital, and a perfect hold on cash conversion cycle are among the key factors. A consistently growing asset base with an ascending trend year after year, a testimony to a very effective business management. A corresponding growth in equity from successive plowback. Equity forms a substantial half of the growing assets. A very moderate debt at about a third of equity is reinforcing a strong capital structure. It also highlights availability of additional borrowing potential for future growth. The revenue has been on a downward slide for over an year now. For the first 2 quarters of FY26, the revenue has a negative growth of about 6% in aggregate. Falling yields from legacy oil fields and a poor sales realization per unit have together damaged the H1 revenue growth. ONGC standalone profits, the major component of group profits, have unfortunately suffered significantly. The year on year fall in the volume of profits has continued unhindered. The double digit fall of H1 FY26 and its potential to disrupt the current year performance is a cause for greater worries. The share price, which was falling over multiple quarters, is looking up of late, and that is a significant development. The price earning multiple is attractive compared to the peer average of greater than 10, but it is equally necessary to note that the PE multiple is well above its own historical 5-year median, and possibly that is the reason the market is a bit indifferent. The share price, incidentally, appears well below its book value, and that is an additional attraction. But you look at the relation between book value and market price over earlier years is essential to understand its implication. The gap between market value and book value makes an interesting study. Over the years, market value has trailed the rising book value, a pattern imposed by market on the ONGC business model. Interestingly, the gap has narrowed down in the last 30 months, a positive for ONGC, but the fact remains the gap is not a measure of potential upside, but a discount thoughtfully applied by the market, duly considering the risk profile. It is noted that ONGC share price and global crude price have a synchronous movement, suggesting a direct correlation between the two. The share price getting into bearish zone in late November 2024 and its exit therefrom in recent times have a corresponding crude price walking along side by side. The recent spurt in global crude price due to geopolitical reasons had an immediate reciprocatory move in ONGC share price, suggesting the relationship to be quite evident. Post its crash from August 24 peak, the share price remained in its sideways movement for the whole of 2025. The recent spurt in the crude price has prompted the share price to attempt its movement across the rectangular boundary with a likely ascending trajectory in the near future. The share price had its failed move to exit the bearish zone late November only to re-enter in mid-December. Recently, the share price managed to move out, crossing over long, medium and short-term exponential moving average with active support from a heavy volume. That is quite reassuring on the likely way forward. ONGC, a proxy for India's energy sector, expanding into natural gases market, massive operations, robust returns and a solid balance sheet, rising costs of deep water exploration and maintenance, higher capital expenditure and falling productivity from legacy oil installations, directly impacted by oil price volatility, the fossil fuel based business model under challenge from renewable energy and electric vehicles. Uncertainty in Iran and the Middle East could cause supply disruption and keep prices at elevated levels. The unpredictable and ever-changing policy decisions on aspects like windfall taxes, royalty rates, etc. could add to the uncertainty of financial performance. Hope you found this presentation on ONGC to your liking. I am Vittal Prabhu with the fortnightly video on Stock Learning Simplified. You can access quality videos at our info card. We look forward to your valuable feedback and suggestions for improvement. Highly obliged for your kind attention and valuable time. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.